Hello, and welcome to FidelityConnects. I'm Dave Bushnell, Senior Vice President of Advisor Sales here at Fidelity. 2025 has kicked off on a high note. Last week, Fidelity Canada proudly announced that the Fidelity All-In-One Balanced ETF has crossed the $2 billion mark in AUM. And thanks to you, FidelityConnects was ranked the #1 podcast in the 2024 Environics Advisor Digital Experience Study, and that's for the 4th year in a row. This year, we're committed to bringing you even more timely market insights and innovative products. How is Fidelity Canada actively contributing to the success of its advisors, and what new products are on the horizon for you to explore? Joining me for a look at how Fidelity is here to support you and your clients this year is Fidelity's Vice President of Product, Andrew Clee. Andrew, it's always good to see you.
Yeah, thanks for having me, Dave.
So you and I have done these shows before. It's always fun to recap different things, talk about what Fidelity's going to be getting up to in the year to come. So I think we'd both agree that 2024 was a weird and wonderful year. There was very interesting tax things that we can perhaps get into that may or may not now really be happening. We had currency movements, we had crypto movements, so lots of great things we can unpack in the next half hour. But could I maybe turn it over to you to start with, what in your opinion were the biggest things that we saw happening in the markets last year?
Yeah, so talk about risk assets. What an incredible year. The S&P 500 was the clear winner. So US equity was the home that everyone wanted to be in. Canadian equity posted a pretty decent return itself. Crypto obviously had an incredible year. So I would say when we look north of the border, south of the border, ETFs posted record inflows. US equity was the largest contributor to those flows. We had a lot of news into November with the presidential election. We saw the Trump rally. We had inflation today. It seems to be top of mind again, just given what we're seeing out of the US government. But a lot to talk about today, but last year was the year of risk assets, so it was an incredible year to come out of.
It certainly was. So, and let's start, you mentioned ETFs, maybe an interesting place to start. So we had 2 years of very, very challenged mutual fund flows. We went positive last year. That was a great thing. But to your point, ETF flows have really been consistently ticking up every year. What have you seen there?
So Canada, about 76 billion went into ETFs, and so that smashed the previous record. So about 45% higher in Canadian ETF flows versus our previous record, which was set in 21 when you remove the double counting. US posted north of $1 trillion of ETF flows. So in Canada, we run total industry about $500 billion. US also surpassed $10 trillion in assets last year. So we had records north and south of the border. But to your point on mutual funds going positive again, I think we are seeing demand for active mandates. So just to put some context around that, over the last 5 years, active ETF launches in Canada have doubled that of passive. And we really saw an acceleration in 2024. And to put even more stats behind that number, about 22.5% of all flows last year in Canada went into active ETFs. And I think what we're seeing is seeing the mutual fund business switch from negative to positive at an industry level also suggests that we're kind of looking, saying, hey, these 7 stocks that make 40% of the S&P 500, in the environment that we're facing, that we do expect heightened volatility and unknown policy that could come out of the Trump government with a lot of uncertainty there, this might be the environment that people are shifting back to active after what seems like 15, 20 years that the passive was the place to be. And we see it in the States too. So active ETFs are much younger in the States. Canada tends to be a leader in innovation in the ETF space. But about 8.5% of US ETF flows went active last year. So that's the highest number that we've seen there. So we're seeing big shifts across mutual funds and ETFs.
And let's stay on the topic for a second. Do you attribute that mostly to your point of the Mag 7, and I think is 40% of the return last year? Do you attribute that to people saying, I want to either get out of the way of something that's coming down the tracks, or I want to get in more on something that's going to grow? Is that why you've really seen this trend accelerate?
Well, so it wasn't the return, it's 40% of the market cap.
Right.
So it's a heavily concentrated index that exists in passive today. And if any of you have watched Joel Tillinghast in the past or Solemn Hart, they always like to pull up the decade leadership chart of the top 5 largest, top 10 largest companies within the S&P 500. And it seems that there's no consistency of, let's call it, durability of that top 5 or top 10. So if we go back to early 2000s, we would have been talking about Exxon, General Electric. Then we kind of shift into the tech wave. Microsoft actually has been durable. That's kind of been one of the largest, but we've seen a lot of in and outs there. And what we saw in 2022 when inflation expectations dramatically increased, and we kind of got that first wave of, no, this is not transitory, this is going to be more durable in inflation standpoint, tech really, really sold off in that environment. As we got into the Fed easing cycle last year, tech flew again. So I think what we're seeing is with the tariffs that are being proposed, potential reinflation, the Fed not as expected to cut as much as we had, let's call it a year and a half, a year ago. Should I diversify away from that concentration that sits in the S&P 500? So I think that's reflected in active flows that we're seeing, not only in US and Canada, but we're also seeing it in Europe.
You said a lot there. I want to pick up a few pieces of it.
Yeah.
What is your thoughts? We saw 2 years ago, we saw record flows into GICs, into cash. We saw just a crazy amount of money both here and in the US going into these HISAs. We're now seeing that coming back, and it's coming back into active, which is interesting.
Yeah.
Do you see that trend as a continuum? Because there's still, I will say, record levels of cash in a lot of places.
Yeah, it's going to be really interesting to watch how this equity market plays out, because I think what's different now versus 22 or 23, as we went into 23, is the valuations are stretched now compared to where we were then. And that is concentrated in a few sectors, like the tech sector, that is incredibly expensive. But your point, HISAs actually went negative in 2024. So the government regime change on how the capital treatment of banks on these HISA products, that went away, so we saw money leave the HISA complex in 2024. We saw that money picked up by money market. So we had a decent year in our money market fund. We were talking about that this morning. Yep. We saw some money market ETFs pick up the flows. So it seems the HISA trade's gone away in favor of money market, but it's going to be really interesting to watch as the BOC is in its easing cycle, and the situation of the Canadian economy is much different than that of the US economy. That GIC money will need to find a new home, and we are seeing it go back into risk to a degree.
And it's impossible to predict the market, but looking backwards, and I know you're a huge student of this, 2 great years in a row.
Yeah. 2
of really the best years in a row I want to say we've almost ever seen. Where does that put you in your head for going into 25?
I think the US economy is different than what we're seeing around the rest of the world. They saw huge productivity increases in the US that the world's having a difficult time to match in terms of, like, you can look at a GDP per capita however you really want, but at its simplest form is GDP is output per worker. We have 2 ways to increase GDP. Is you increase the number of workers and you can make more things, or you can make the worker more productive. And if we can make the worker more productive, that means we are seeing productivity gains. And given that you've seen relatively strong gains in US GDP and not huge changes in labor, there's a strong argument that the US is seeing really, really strong productivity gains relative to the rest of the world. And Canada, unfortunately, is seeing productivity decreases. So we are trying to increase the workers, not seeing productivity. And so even I think GIA was saying this earlier this week, they remain optimistic on the US equity market. So that continues to be one of their overweights. The rest of the world's equity market's in a little bit different situation, just given the strength of the economies relative to the US, but also the dynamics of our mortgage markets and the higher interest rates impact of that. Because in the US, you actually fix your mortgage without renewal for 30 years. That can't be...
Sounds nice.
Yeah, it'd be lovely. We can't say the same for Canada, the UK, or most of Europe.
And let's talk about something else you mentioned. So I feel like inflation was the only thing we talked about for 22, 23. It looks like it's subsiding, but it is interesting, and you and I heard from someone the other day, is it going down? Is there risk of it going back up? I feel like this might become back into the headlines.
Yeah, it's definitely on our mind right now. So, like, today was an important day. Happy Inflation Day, everyone.
Yes, market's happy.
Yeah, the market is very happy. So we see both bonds and stocks rallying today. So on the back of that, the core inflation number, excluding food and energy, came in lighter than expected. So it was 3.2 versus 3.3. The headline figure matched estimates. But I think what was important of it is that services came down. So services was that sticky inflation that we were probably talking about a year and a half ago. It wasn't a huge decline in service inflation, so it's nothing to really write home about. But seeing services soften is something that we felt was going to be stickier in the inflation headline. Something like goods, you can really adjust the prices of, just because if we sit on excess inventory as a company, we're probably going to slash prices to get that inventory out. Otherwise, it's capital cost to us. Wages, which is like basically services, we have to pay people to provide services. You can't really retract those wage increases that we saw. So the market likes it, but I think what we will start hearing about probably throughout today and in tomorrow, and it's fresh news, but my first thought was, does this softer inflation give the Trump administration further confidence in putting the tariffs on the imports? Because I think over the last week we were saying if inflation was hot today, they might have to think their tariff policy. Right. Because at the end of the day, imposing tariffs on imports probably increase prices for US consumers. Like, companies don't really like to take that on, and if you have decent price inelasticity or elasticity, depending on where you sit, some companies can actually pass those price increases that they're going to be paying the tariffs on to the consumer. So does this give him further confidence to impose those tariffs? We don't really know. And we're going to find out in about 5 days what the actual plan is. But he did announce the External Revenue Service.
Yes.
So it does sound like he's going ahead, and this softer inflation probably gives them more confidence to do it. So I think we will be talking about inflation again in 2025 once we see policy roll out.
Just keeping on inflation, how much do you think the market was getting excited, especially at the end of last year, that rates are coming down, money's going to be cheap again? With the U.S. sitting at a 4.1% unemployment rate, strong numbers, if they don't cut, do people lose that excitement? If everyone believes that that's sort of baked in, I'll call it, and that there's going to be cuts, if they say, well, no, actually everything's working properly and don't cut, can we still be as excited about the prospects for this year?
So I think the important thing to think about the stocks is they're probably looking at inflation expectations. And the reason I say that is tech had its bad year in 2022, and we didn't realize the high inflation until 23, but it was the expectations of inflation that were driving that tech sell-off in 2022. And so what stocks are really good at is pricing in forward expectations. So if we see a reacceleration in inflation expectations following these tariff announcements, that probably does not bode well, kind of the repeat that we saw in 2022. So it's about what the market is expecting, and following today's print, we still expect cuts in 2025 from the options market. But if those were to be retrenched and the Fed is expected to hold, then I think you have some issues that could appear in some of the overstretched valuation market. So it's all going to be around expectations. But I do have a feeling that inflation is going to become topical over the next several months again.
And there are a few more themes I want to hit on before we change gears a little bit. One that I always love asking you about is gold.
Yeah.
I feel like once crypto came out, everyone forgot about gold and nobody talks about it, yet it had an absolutely breakout year last year. I almost call it a record year last year, but yet still try and find a headline on gold. It's a tough thing to do. Do you have any thoughts on that?
Well, so the launch of the US ETF in the States in Bitcoin surpassed the AUM of gold ETFs.
In 1 year.
Yeah, in 1 year. So my stance on that is gold and Bitcoin have very similar characteristics in terms of finite supply, store of value, barter of exchange. There's arguments that they offer similar properties. Gold has the longest history in terms of track record. But the buyers, this is like kind of ongoing thoughts and research of what's happening, is the buyers of the gold may now be diversifying into Bitcoin to a degree. And the launch of the ETF and the demand that you saw there, I think would argue that gold may have lost some of its shine for, like, we call them gold bugs, but some of those gold bugs might have now diversified into Bitcoin. So I think it's now competing for a similar pool of assets that it previously didn't have a competitor in.
Crypto bugs.
Yeah, crypto, yeah.
Well, great segue though, so let's go to crypto. So again, I mean, I think of our journey with crypto, that we came out with our product here in Canada. We're very excited about that. went up a little bit, very turbulent around the 50,000 mark. Trump comes in, we explode up to really, I think 103 or 100,003 it peaked at. Now we're back, I think, in the high 90s. Interesting point now, because now it seems to be, I don't want to call it range bound because it hasn't been very long, but it seems to be bouncing around it, that 100,000. Interesting, one, the run, and two, where does it go from here?
Yeah, so I think the Trump administration gave the market a lot of optimism around it. It seems the soup du jour is central bank reserves. So a lot of question of whether the Trump administration will put a Bitcoin reserve into the US. We've seen it in emerging markets. So it is a fascinating development. But it was the best performing asset class last year. So it was a strong contributor to portfolios that held it. But the launch of the ETF, I think it's the first time in history, at least to what I can see, that Main Street has taken something to Wall Street. So this was one of the few asset classes that digital natives adopted in the 2009 to 2013. It probably came on to digital adopters, let's call it 2013, 2015. But it was really kind of the 2021 that we started to see institutional interest in it. So every other asset class that I can remember, look back through history, it started on Wall Street and then was sold to Main Street. This might be the flip there. But part of the price gains was also due to the halving. So we did have a halving event historically. So what that means is that miners receive half the amount of Bitcoin per block that they create. And that has historically led to price appreciation. But Bitcoin, interestingly, also is very sensitive to inflation expectations. So it's provided a nice diversifier in recent years. So it's tough to say whether it's a risk asset, a risk-off asset, because it seems to do its own thing, similar to gold. So it's going to be really fun to watch.
It will be interesting to watch. I want to change gears a tiny bit. Anyone tuning in today that spent some time in their holidays down in the States might have been greeted like I was when they got back and looked at their Visa bill to a nice 40% on top of whatever they thought might have been a good deal at the time. Haven't seen a spread like that in a while. Many are thinking it's going to keep going. How does that factor into perhaps not only last year, but looking into this year as well?
So this is probably one of the first times in decades that we've seen a huge divergence between the Canadian economy and the US economy. So typically, the old adage would be, if the US sniffs, Canada catches a cold. The US hasn't sniffed and we've got a cold. So we are starting to deviate from that. And the interest rate differential is part of that story. So historically, kind of the widest you'd get from a difference in interest rate policy, let's call it 1 to 1.25%, where maybe we're 1.25% cheaper on our central bank policy versus the US. This looks very different because we acknowledge that we have a productivity problem in Canada. We acknowledge that these tariffs, the proposed tariffs of 25% would be devastating.
Especially in Ontario.
Yeah, and Alberta, which produces a ton of oil for the US on a daily basis. And the specialized manufacturing in Quebec. So there is a very important relationship that exists between the Canada and the US. And so not only do we have divergence in interest rate policy and interest rate policy expectations, where the Bank of Canada is still expected to cut, and we're maybe saying, you know what, the Fed probably doesn't need to cut, at least till the second half of the year, because they might start getting to worried about the US economy overheating. And they don't want that. So could it get worse? I think it's going to depend on what does that tariffs look like, but what we have a really good history of doing in Canada is what makes your exports more attractive is a weaker currency.
Yes.
And so if tariffs do come in, what is the logical response? Is our economy is going to get weaker, the central bank will have to act on a weaker economy, and we also need to make our exports relatively more attractive to the foreign buyers, and that can be in the form of a weaker currency.
So you're telling everyone on the call their March break, if they're going outside, might be a little bit more expensive, is what Andrew Clee's telling us.
143, 144 today. Next week we'll have insight into what that
what it'll actually look like.
Yeah.
Okay, let's look into, let's switch gears a little bit as we approach about 10 minutes left in our program. Let's look to this year. From a product point of view, from just a trend point of view, what are you seeing shaping up so far as the first 2 weeks of the year here?
Yeah, so what I think we can expect to continue is the demand for ETFs relative to mutual funds to continue to grow. So that vehicle is really taking off, given the structure and the operational natures of it. But I think more importantly, what we'll expect is a slowdown in passive in the shift to active. And I don't want to make an argument on whether stocks will go up or down, but I'd rather make the argument that stocks will be volatile. And the reason I say that is there's so much uncertainty related to new government policy that what will be enacted versus will not be enacted, because it's important to remember that when we go through a presidential cycle, a lot of campaign promises are not actually executed in principle. So we have that uncertainty. Earnings growth, I think, will be dependent on tariff policy and what that could look like. Inflation's a big variable that we're waiting on. So up or down, I do think is volatile. And that tends to lend itself to active stock picking. And then second, we touched on the 40% concentration in passive, that we're already starting to see shifts out of that market. We've seen a very large passive ETF issuer launch a 3% cap-weighted S&P 500. Why would you do something about that? Is they clearly see the tides changing in terms of the concentration that sits in the S&P 500. So I do think that this setup is extremely positive for active management, specifically Fidelity, where we have some of the best research in the world in US equity. But I think the other trend that we need to look out for is where the 10-year yield sits on bonds right now, specifically US. So we saw the 20-year break 5. So that's been a long, long time since we've seen that. The 10-year yield was sitting at 4 3/4 a couple days ago. It's down today, so let's call it 460, 465, somewhere in that realm. I didn't check it after CPI. It could be slightly lower. But these are attractive levels to take on fixed income exposure again. So we saw that trade come in 23. The last time we had that yield curve significantly higher, that like similar levels to what we saw today. Only the short end of the curve is inverted. So kind of that belly of the curve, let's call it 5 to 7 years, is a pretty attractive interest rate environment to lock into. So I would not be surprised to see a pickup in fixed income flows in 2025 as the Canadian GIC market lowers with the Bank of Canada. Those yields that were being offered to us through the yield curve right now become more and more attractive.
Andrew, let's switch gears in the few minutes we have left here. As always at Fidelity, I think people come to expect from us, we're always scouring the globe and the Fidelity ecosystem and what we can do. And we're very excited that we're going to have 3 new products joining us shortly. An absolute income, a U.S. core bond, and a U.S. equity coming to market. I hope many of our viewers have seen Neil Constable before. He's a new name, but he's going to become a household name with Fidelity. He's joining us next week at our big show. Can you perhaps just talk to us about the catalyst for this launch and why we're really quite excited about, I'm going to call it really a new way of thinking for us with this lineup?
Yeah, so quantitative investing has existed since let's call it the 90s, like Fama French. We all read the factor model, small caps, value, liquidity, whatever you want to look at. The background of this is quant has evolved, and I want to say this is the next wave of quantitative investing where we are marrying fundamental with quant. So I don't want to call it quant, because what we are doing is we're taking all of our research that are used on the fundamental side, and then we're looking at triggers on what certain analysts do well and what they don't do well, and trying to isolate those strengths and mitigate some potential weaknesses and put it together in a total portfolio. So if you take advanced US equity, for example, that would look at things like our analyst price targets, how they compare to the sell side research. They would look at our buys and sell rating on the stock. But what's not known to much of the world is that every single analyst at Fidelity also runs a portfolio of all their stocks under coverage, and they're benchmarked to the S&P 500. So which stocks in your coverage are expected to outperform the market? So we're pulling in all of these signals of our analysts that meet with thousands and thousands of companies a year, and then optimizing in a portfolio. And so hedge funds have been doing this for a very, very long time. So if you take the major hedge funds in the States, they have what they call their central funds or the flagship funds, and they have pods of PMs that run long short equity and they can kind of do whatever they want. But usually those central funds are saying, you know what, Dave Bushnell is a really good stock picker, may not be the best sector rotator, so let's isolate his sector bets, take that out of the fund, take his best stock ideas, put that in the central fund. And what Neil was able to do was attract a ton of hedge fund talent. And the reason I asked all these guys is, why did you leave these massive, massive hedge funds? And they said what the hedge funds were really good at was the alternative data sets. They lacked the fundamental research because we could only employ 10 to 20 portfolio managers, didn't have a bench of 300 analysts. So we relied more heavily on the alternative data, less so on the fundamental. And Fidelity gave them the budget to match that of the hedge funds on the alternative data side. But then we also have 300 analysts. We have hundreds and hundreds of portfolio managers. And maybe the smartest thing we ever done was save all our research notes that have ever existed.
Right.
So they had an archive of historical, fundamental buy-side research notes that date back years that they could comb through to figure out what was intelligent signals. And so that's what we're bringing the US equity mandate. I'm fairly excited about it because it's relatively unique and there's very few people that can compete with the talent and the scale that we can bring to that market. Absolute income, really exciting story. So we're talking about high interest rates right now, but credit spreads are really tight. So the objective of absolute income is to deliver 90% of the high yield index yield. And you would say, well, how would you do that? Well, there's things like credit default swaps, interest rate derivatives, futures, that we can actually hedge out some of that risk while delivering a very attractive yield that, say, 90% of high yield. And why are we excited about that today is you'll say, okay, interest rates are high, that's attractive, but the counter argument is credit spreads are incredibly tight. So introducing a product that can make use of credit default swaps can remove some of that credit widening risk in this type of environment. So really excited about that. US core bond is just a sister product to our systematic Canadian bond. So about 25 to 40 basis points yield over the US ag. But I think what's important is the difference dynamics in the strength of the economies. So it's almost a clone to our Canadian bond ETF, but it's focused on US, and if they are in a stronger position, if there is a chance of a recession, that credit quality of the corporate bonds underlying the US, we would expect to behave a little bit better if Canada did enter a recession.
So never a dull moment at
No.
Fidelity, as there always is. And we'll get to hear more about these products next week at our big show here in Toronto, but being broadcasted across Canada. So Andrew, thanks as always for a great and insightful conversation.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.